Hello, it's John Burford, and this is the video where I put it all together. This is combining the three different methods I use: the tramline trading, the Elliot wave, and the Fibonacci. Okay, so the big question, of course, as traders, how do we make money by spread betting the financial markets? There are two main factors here involved. First of all, you need to reveal the order and structure in the markets, because it does exist, and the Elliot wave, Fibonacci, and Tramline ideas give me those clues. These are time tested. I've used them for quite some time now, so I think I've proved their worth. Now, the equation that I like to think about when I'm trading is that if I have a high probability entry and I add good money management rules, say my 3% rule and my break-even rule, and those are covered elsewhere, then that equals an edge. I've got an edge in trading, and this is all we can have. That's all we can ask for when we're trading. Markets are inherently uncertain. There's no certainty whatsoever about where they're going to go, but of course, using the methods I use here, then we can have at certain times a very good idea of where they're going next. Now, if used correctly, these methods can give you a definite edge. All right, the second factor here is you must act promptly and decisively when you get your signals. There's no point sitting around saying, "Oh yeah, I've met my goal, and I think I'll wait a while and see what happens." Well, I'm afraid seeing what happens is often a formula for disaster, because inevitably you're going to be getting in far too late, and your risk just shoots up, and your account may well suffer. So you need to be able to pull the trigger when necessary. Now, your job as a trader or an investor, and for that matter, is to be able to forecast what the other traders are about to do and make your move before they do. Now, that's an important point to get across, so I'm going to say it again. Your job as a trader or investor is to be able to forecast what the other traders are about to do and then make a move before they do. That's all you need to do. It sounds simple, doesn't it? It's not really. But it's definitely not an arena where you can impose your views and your will on the market. So if you have a very strong view, it's best to leave it at the door, take a look at the screen, and trade off the screen and off the signals. Okay, we all have views, of course, but you need to train yourself to continually measure the validity of your views against the market action. So if the market's going down and you're bullish, then Houston, you have a problem. So it's best not to be married too much to a particular view. Let the market decide what it wants to do. All right, I've got here in front of me the daily Wall Street, the Dow Jones, going back to March, the famous low in March 2009. And you see the tram lines I've drawn previously in another video. And since that video was made, by the way, the market fell promptly right down to it, a slight overshoot, of course, and now it's in the process of bouncing up a little bit. Okay. So how do we trade using our concepts here? These are the tramlines, as I say. Take this one, for example. This is a very good one. This one here, the top one. That is a line of resistance. So when the market came up off the low, it hit the resistance, tried to bounce off, hit it again, bounced off, went up again to challenge it, and third time lucky, which is normal in this case. When you have three challenges, the third time is lucky and it pushed through. But now that line becomes support. Every time the market came down to this line, it acted as support for quite a long time, until it broke it here, of course. Okay, so that's the first way you use my tram lines. Let's go now to a tighter view. Okay, so we've got our tram lines, and when the market came down to my central tram line, these are obviously buy points. You'd be buying in this region here, buying in this region here. We missed those two, by the way. But this is such a very long-term tram line. There are other tram lines at work, of course, all the time. But I'm just going to show you the basic principle on the strategy you need to employ to use these tram lines effectively. Okay, if you remember the video on the Elliot wave, how I use that, then you know that from this low here we had a rally up here, and this came down to an exact 50% Fibonacci retracement. What I'll do is I'll scoot it up here so you get a better view. There we go. Okay, this rally here was met by a Fibonacci 50% retrace and then carried on. So that's an example of using, first of all, tramline method to get long here. If you took profits here, if not, or you could have added in this point here as it came down to the 50% Fibonacci retracement. So those are two excellent methods of giving you very low risk entry points. Okay, now let's go to more recent trading, which is more interesting, I think, for most of you. Right, okay. Let's go back to that point there. The market came down to the central tram line, rallied, came back down to test it again, and then rallied up. Now let's go to squeeze it up a bit, I think. Yes, that's better. So if you remember the video on the Elliot wave, we counted that as wave 1, wave 2. That's a very, very strong thrusting wave 3. This is a very good wave 4, which came down to a Fibonacci retrace, if you remember. And then a rally to a new high at the 12,800 level. Now, I called that the high at the time, if you remember, if you were following my emails. One of the clues, of course, was that was a fifth wave, which is an ending wave. When 5 waves have ended, then you get a reversal, which is what we've seen. But also, this fifth wave here was made on a much lower momentum reading than the third wave momentum reading. So we had a negative momentum divergence. It was very strong at that point. So that was another clue that the market was ready to reverse at that time. Okay, so we've used these points to get long from the tramline methods. I've used my Elliott wave theory to call that as a high, and I've used this point here as a Fibonacci retracement in case you were going long here on a short-term trading basis. This is more of a long-term position simply because of the period of this. That's about a month and a half, something like that, a little over a month and a half. So I expect the retracement to take about the same length of time, say around 6 weeks, something of that order. Okay, I can show you more now. If I go to, there we go, current trading. I can now go to the 2-hourly chart. I think it shows up quite well there. There we go. There is the 12,800 high that I called. The big plunge down doesn't look so steep here, but that is actually 10,450. That's well over 2,000 point drop in 11 days. It's a very substantial move. So these are the tram lines that I drew, the very, very long-term ones. Now, at some point, tram lines do actually peter out and a new set take over. So it's always a good idea when you're trading against very long-term trend lines. This one is 2 years or more than 2 years old. Is to keep looking for a new set of tram lines. But I can show you a really good Fibonacci. I go for my Fibonacci tool here. Here's my high pivot. I go down here. Here's the low pivot down there, 10,450. And right away we see, I can actually scoot it up here to show you a bit more detail. We don't need that much on the right hand side of the chart. There we go. So we've got an A, a B and a C pattern. Now that could be a finished wave. This C wave could be a completed wave, but notice how it's fighting with this Fibonacci 38.2% level. So right away, this is massive resistance, and of course it's taking its time to decide what to do. So from a trading standpoint, you'd be shorting in this area here. You would be putting a stop somewhere in this region here using your 3% rule, and expecting a fall. Now, it may not fall, of course. The market may continue going up, so that would be the very next target. So let's see if we can find any tram lines from the top. If I get my trend line generator, I use that as the top. I swing it down, and it clips that high and that high. So I've got 1, 2, 3 touch points. That's enough for a tram line. Extending the line down here, I would expect if the market reached this line here, that would be pretty good resistance. So for a stop, I would put my stop, if I was shorting in this region here, just above that line there. Okay, let's see if we can draw any more tram lines. Let's get rid of those, all the lines, the Fibonacci, and we will, we're on the 2-hour chart. Let's go to the 1-hour chart. Okay, let's scoot it up here. Okay. Now I've got a low here, and I always, when I find a significant low, another low, which is higher than that low, I always like to draw a tram line. So, there we go. Right, okay, that's a good tram line. All I need is 2 points. Let's draw a parallel line above and see what we come up with. Well, that's quite clever, isn't it? I've got this very significant high here as a touch point, and don't forget these back here. And if you remember from the tramline video, I always like, on the second tramline, this is the first one, this is the second one, to find good touch points prior to the first touch point of the lower tram line. So this is all trading that happened beforehand, and sure enough, I've got all these 3 lovely touch points. So that I consider that a very valid tram line. So if the market decides to get up here, that would be resistance. That would be resistance too. So this is significant resistance for any further advance. So if you weren't short at that level here, you would definitely want to be short if the market reached up here. But of course, we're in the real world. The market may not. It may decide to fall back down, in which case we'd be resuming the bear market that started earlier in August. And how would you get on board if you missed that? Well, that's a tough one. It's very tough. I would say that if we just scoot this up a bit and start another tram line from this low here and touch that low there, here we go. So we've got a low here, and look here. Just in the last few minutes, as I record this video, we've got a test of that line again. That's a really good tram line. Let's draw a parallel one and see which way we go. Oh, look at that. That is quite remarkable. We've got a super touch point here, super one, and that one there. So those two are valid touch points. So I would say, if the market didn't reach up at this level here, I would put a sell stop underneath this level here to get short, looking for a fall down here. Now what would be my target? Okay, let's create a parallel line and try and place it equidistant, something in that region there. So that gap is equal to that gap. So if the market decides to fall beneath this area, then that would be my initial target in the, it looks like the 11,000 area. So that would be my plan. So you see how I use a combination of Fibonacci, Tramline and Elliot wave methods in my trading. This is a real live example. I'm just recording this straight off the screen, and so I hadn't made this up at all. So that's exactly how I use it. So if you want to be familiar with these methods, then you need to do a lot of practice. Go over your charts, put your tram lines in, look for the second tram line, look for the third, look for the fourth, and see how accurate your touch points can be. That one I just created, that one it just passes through there, that one there, I was eyeing that one as I created this line, and looked over here, and sure enough, a beautiful touch point. So there we have it. I hope you have fun with these methods, and I certainly hope you have success. Success is your way, of course, if you use the methods properly. So I hope you will, and I look forward to giving you a lot more emails as the markets develop.